The professor here. Let us talk about what's going on in the stock market. More interesting enough, let us talk about what's going on with the P ratio. Why do we care? Well, because the P ratio is being used by investors as a mean to evaluate whether or not you are over or undervalued based on the price of the stock and the earnings per share. Do you believe in earnings per share? Do you believe in cash flow? That's all up to you. I'm going to make a point today. I'm going to make a point that if you look at 1929, we reached a high in terms of the P ratio. And look what happens after. Look at what happened in 1999 and look where we are today. Then look at where we are today and look what's been happening for the past few months. The market has been down for about 25%. Now, why is that? Well, obviously more people are selling than buying, but more importantly, there are fears out there that we are in inflation and we are going to hit a recession. Why? It's simple. The Fed, only tool that is left truly is the interest rates. So they're raising interest rates in order to combat inflation, which makes sense. You cool down the economy because you make things more expensive for people to buy. But we don't have an inflation driven by demand as much as it is driven by supply. You can't get a car, you can't buy a car, you can't find people to work for you, so you're paying them more and more. The supply issue. So yes, at the end of the day, if you raise interest rate, you could impact some of the demand driven inflation, but not the supply driven inflation. The Fed wasn't built for that. So while the inflation is being fought in some level, now because you're raising rates, you're applying a tool that is used to combat inflation, but not in a recession environment. So what you're going to have is you're going to potentially create a recession by slowing demand. And you still can't get a car. So what does it mean for you as an investor? Well, look at how far we've gone. Since fourth quarter of last year to now, we are at about 20-25% drop in stock price, right? So if you look at historical figures, and you could see how low we've gone after each of those high events, but more importantly, look what happened the last time we had a stagflation, and that was in the 70s and the 80s. And look what happened. Look at the drop. But forget the drop. Look how long it took for you to get back to where you were. That is a problem. And that we're going to need to face, because ultimately, as you go through the years, potentially, for you to be able to recover? Now, does this mean that because it happened in the past, it's not going to happen in the future? We'll see. But I could tell you that inflation is, quote unquote, very sticky. You don't get rid of inflation that easily. So if we've done already, we look at the chart. If we're down about 25%, and look at where the P ratio is, what do you think it's going to look like if we drop all the way down? We don't know. As an investor, you should always say, I just don't know.